Hello and welcome to Moving Iron Podcast Markets with Chip Nellinger. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. Axon Tire would like to give the loyal listeners of the Moving Iron Podcast a free Axon desk pad. Anyone who emails marketing at axontire.com, Axon will send out an Axon desk pad. Make sure you mention the Moving Iron Podcast when you email marketing at axontire.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. And no matter how you buy your ag equipment, whether it's from a dealer, an auction, or a private party, AgDirect can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. Tractor Zoom has over $20 billion in heavy equipment sales. Tractor Zoom's Iron Comps is the industry's trusted solution for transparent equipment values and auctionable pricing insights. And finally, this podcast is brought to you by Axon. I did that one. It's brought to you by Anvil AppWorks. Their Dealer Connect CRMI app with integrated inventory management is an affordable Salesforce-based solution for your dealership. Create connected customer experience and transform how you work. Chip is with Blue Reef Agro Marketing out of Morton, Illinois, and he is nice enough to come on and talk about what's happening in the marketplace. Chip, how you doing this morning?
Hey, good. How you doing, Casey? It's been a minute, so they say, since we talked.
Been just a skosh there. A lot of stuff going on, Chip, man. I'll tell you what, it's been a very topsy-turvy market. We're in the middle of no one said we are yet, but we're officially in a recession, sounds like. And
something like that. Yeah, we won't know that though until we're like way out of the recession, and then we can say, now we're in a recovery.
Yeah,
but we can't say we're in a recession while we're in a recession. Only after.
You can only recover after. You just jump from fine to nothing bad to see here, folks. Keep moving on to no. Guess what? We're in a recovery. So like what?
Yes.
How's that work? Yeah. So
yes, that's right.
So we got that going on. Oddly enough, the price of the dollar has maintained its momentum and actually grown in strength compared to other currencies around the world. So that really shows you how worse off the rest of the world is comparatively to where we're at. So I guess looking at the dollar and what we saw happen yesterday, especially, there's this huge sell off in all the commodities across the board. Even the stock market took a big hit. I guess looking at that dollar, Chip, what are your thoughts there, and how do you see that playing into this, last quarter of the year selling and going into that first quarter of the year marketing plan?
Yeah, well, 20-year highs in the dollar index yesterday. So I call it the cleanest dirty shirt syndrome. Not that anything's great right now. We're just the least bad of anyone. And so you go back a couple of weeks here to the Federal Reserve Jackson Hole, Wyoming meeting. And they pretty well reiterated that we're going to do everything that we can to keep interest rates, increasing. We're going to stick to our guns here with, regular measured interest rate increases to try to combat inflation. And really all currency and dollar fluctuations is interest rate differential. So as our interest rates go higher, faster than other parts of the country, it becomes friendly to the dollar. And, So, with that being said, that also becomes problematic, especially in emerging markets. It fuels actually faster and worse inflation in those countries. It's just, whenever there's a little ripple on the pond, it heads out in all directions and affects everyone. So that's the backdrop we're in. Inflation is still fairly high. The Federal Reserve says we are going to be diligent. We're going to keep interest rates strong and rising. As of yesterday, interest rates are almost retesting the previous highs. They're up around 3.2%, give or take, 20-year highs in the dollar. We saw crude oil close under the 50-day or the 200-day moving average for the first time in many, many months yesterday. And so commodities are caught in this, back and forth where inflation is still there. Federal Reserve says we're going to fight it with rising interest rates. And, these raw commodities, hard assets are kind of caught in the middle and they don't know which way to go. So it has been a very, very choppy trade. I think that's going to continue. It makes it very confusing. There's, the trends are hard to come by here. The rallies don't follow through to the upside. The sell-offs don't follow through to the downside. As you rally, you have producer selling. As you sell off, you have end user buying. And until further notice, we're probably in that type of a market environment in our agricultural markets. Very, very choppy, volatile, large trading ranges, erratic moves. And we're fighting all this out under this backdrop of inflation and strong dollar. We likely have, our crop size shrinking, and at least on corn.
Yep.
And so that throws, another monkey wrench in there and makes it even more confusing to figure out what to do out here.
Yep. So that was my next thing I was going to talk to you about. You got those crop tours that went through last week, and really, I think they probably reaffirmed, I think, what the trade had thought already. Probably a little more aggressive than what some of the trade thought. Obviously we saw some huge numbers run up, and we're seeing that weather premium get built back into the crop that we see out there now. But when you're looking at, I think Pro Farmer pegged it around 168, and a couple other places out there were in 170, and basically everyone kind of agreed on about a 50 bushel per acre number for soybeans. I guess looking at that chip where we at carry out now, what all the weather situation that we have going on now. I mean, we're really still at zero. It feels like.
Yeah, that I thought Pro Farmer was fairly aggressive. Typically they're, in my opinion, a little more conservative. But as they move through from the very first day on each extreme, the eastern extreme out in Ohio and the western extreme in South Dakota and Minnesota, they just found consistently disappointing yields.
Mm-hmm.
And even as it got better into Illinois and Iowa and southern Minnesota, pretty variable. And you just didn't see those 240, 250, 260 type yields in in the best areas. And so they came out 168 and change, compared to, I think the August USDA number was 174.9, if I'm not mistaken. And so that was an aggressive cut. We got a strong rally into that report on Friday. They came out last Friday, Pro Farmer did. And, they, as the tour progressed, the market just continued to rally based off of those disappointing and highly variable yields. We tried to rally early, this week, but kind of hit a roadblock here with these outside markets. Mentioned earlier, crude oils, just can't seem to push north of 90, and the dollar's strong, and interest rates rising rapidly. We've had some weakness in the stock market here, and it's really kind of weighed on commodities. You mentioned yesterday, it was just one of those general down days. Sharply higher interest rates yesterday, sharply lower crude oil, and that's all you need to know about how the rest of the commodity world's gonna react here. So on the one hand, you've got shrinking yield potential. On the other hand, a little bit of a disappointing reaction, I guess, that we are kind of struggling here. I guess December corn it's up a nickel right now, 663, but we ran right into some resistance in the upper 670s, low 680s. And a lot of people scratching their heads saying, hey, if we're going to be under 170 bushel yield, why aren't we at 7.25? And the answer to that is the outside market influence. And so it's good and bad. The good news is it does illustrate we've got some problems out there this year with yield. The bad news is now there's a really high bar on getting a bullish yield estimate out of the USDA. September 12th is less than 2 weeks away. We're coming into Labor Day, so we've got a short week next week. There's only 4 trading days, and then the week after. So we're really down to 10 trading days, including today, Friday, ahead of that September crop report. They actually start doing actual field surveys, walking fields, doing measurements on this September crop report. And but now the problem is they have to be pretty friendly. And if they take, historically, USDA takes a measured approach, right? Meaning they're not going to just drop it 7 bushels at once. They're going to drop it 1.5 bushels, 2 bushels, because they have September, October, November, and January to do that, and to get the numbers zeroed in. And unfortunately, typically, as they drop yield, they're also dropping demand out of it slightly, and makes it harder to get just a wildly bullish number. Now, it doesn't mean it's going to be bearish. It's just now the market's expecting sub 170 because of pro farmer, and the USDA here on the 12th likely isn't going to say sub 170. So that sets the market up for disappointment. And we're right on the doorstep of harvest starting. No matter what the crop size is, combines are starting to roll in the South, and within a couple of weeks they're going to be moving into the the heart of the Corn Belt here in the I-states. And it's just a hard time of year for the market to rally. It doesn't mean we don't have great potential post-harvest, but it just makes it that much more difficult and choppy on the trade right now.
Yep. Yeah, and then of course, obviously the true tell of the tape is what actually gets through the combine and in the van. So that'll be interesting. That January report, like you said, you mean if the even if the USDA shows up and says, we're going to drop 3 bushels from what we thought it was, and drop it down to 171 or 172 or something like that, that's still a huge move in the eyes of where that, because I mean the trade knows exactly what you're talking about. So it's going to be that's probably one of the more closely watched reports we'll see this year, just because of how that reaction to that overall market's going to be. So
yeah, for sure. And what the change is, I mean, if it's a bushel, it's going to be seen as, probably a little bit negative. If it's 3 bushels, that might be a little friendlier with the market, assuming that there's more cuts to come. And then, I mean, it just seems like a hamster on a wheel this time of year, because you get the September report, and then it's like, okay, well, in 30 days, now we got the October report to look forward to. What are they going to say about that? And, on the bean side of the equation, Pro Farmer was on the high side. Actually, I think they were a touch over 51. I think it was a little bit higher than where the USDA estimate is. There have been some really beneficial rains around in the last 2 or 3 weeks here in August in areas. It's been very dry and hot. Talking about boarding pods in those areas, so makes it really difficult to figure out what's out there. You got areas that probably improved in the month of August as far as bean yield potential. You got areas that probably went backwards in the month of August, and it's hard to figure out what's out there. You almost have to get the combines rolling through it and figure out what's out there, and that might be more of a October type crop report before we get a little better feel for what bean yields are. And then under this, it's what's China doing. They just continue to lock down cities. That's
I saw it the other day.
Yeah, I mean, it's mind-boggling, really
it's not working for them. So I don't know why they keep doing that, but
yeah, I don't know either. It's almost as if they're purposely trying to slow their aggregate demand down by mandating people stay at home. It's because it doesn't work. It hasn't worked. It doesn't work.
So yeah.
What's the definition of insanity? Doing the same thing over and over, expecting different results. But that just keeps the fear in the market about, are they going into this slowdown? There's already, a lot of signs and indications that not only us and the rest of the world, but China's in a recession. They continue to buy beans. We saw a nice purchase yesterday, 300 and some thousand metric tons to unknown. That's likely China. They've been there multiple times in the last couple of weeks for U.S. beans. But, the elephant in the room here is everyone knows that Brazil's getting ready to go to the field and plant, and they're going to plant a lot of acres. And if Mother Nature cooperates for them, which is a big if, they're going to have a massive crop. I mean, like way over 5 billion bushel crop.
Yeah.
If Mother Nature cooperates, they still are fighting La Nina, and so We got some fun and games ahead of us the next few months trying to figure out this world supply and demand situation and in the backdrop of a world recession. The other thing that's going on here, and maybe you were going to talk about this, I feel like I'm getting long-winded, is this European energy situation is, you know, borderline catastrophic.
Yeah.
And I cannot help but believe that can't be isolated to Europe. There's going to be ripples across the world because of that. That's going to cause it has to. You know,
Yeah.
you have
Energy
individuals,
costs, man.
households, you've got small businesses, restaurants, bars. You're talking $3,000, $4,000, $5,000 a month just for their electricity.
Right.
You're not even into the winter cold time frame when you know the home heating bills kick in.
Right.
So it's going to be a catastrophic several months for Europe. There's no way that
Yeah.
can't push them into a recession. We're likely already into one, even though we want to rewrite the dictionary and all the statistics. You know, it's not a good look we've got going right now
No.
anywhere in the world.
No, it's a struggle for sure. You know, on top of that, though, you've got the PBOC. I mean, and of course, everything China says is above board, but so they got plenty of room to do monetary policy, so they're good to go. So,
oh yeah,
don't worry about that. One thing I do want to hit on is the stuff coming out of Ukraine. So there's about, I think they're up to like 62 or 65 shipments that have left Ukrainian ports. You're starting to see a pretty more regular basis of those getting out of the Black Sea region. What this big surge that the Ukrainian forces have made into southern parts of Ukraine and Crimea and the Donbass region, and what Zelensky has said about where our goal now is victory. There's no compromise. We're not doing anything else. Our compromise is win. So I guess as you look at that and those continuing to see more and more of the traffic coming out of the Black Sea, when you're looking at the market's kind of just factored that out almost. I mean, I don't know if they factored it out, but they factored it in, right? So any Ukraine premium or news or stuff like that coming out of Ukraine just doesn't seem to affect the market anymore. Looking at the Ukrainian situation, Chip, and what's going on with the freighters coming out, I guess, what are your thoughts there?
Well, I think several things. I think that's just going to be the norm for many months to years to come. You know, there's going to be conflict in that area
Sure.
for the foreseeable future, for years and years, most likely, back and forth. And you know, even when there's not officially a war, there's going to be conflict in that area. There's going to be, you know, battles back and forth, and what the result of that is, it's going to make that region less stable. They have put out some grain out of those areas. The majority of that has been ships that were loaded but stranded at anchor or at port. They've kind of cleared that backlog. I understand there is a little bit moving out, but they still have damage to their infrastructure.
Sure.
All it's going to take is one battle or missile strike somewhere, and you're going to bring that whole thing to a screeching halt. I'm quite honestly, knock on wood, surprised that hasn't happened already, that Russia hasn't, you know, thrown a wrench in the armor. You saw a report earlier this week about the potential for the Ukrainian crop size.
Yep.
And it just continued, as you would expect, right? They're still in the middle of a war. There's, you know, bombs in the middle of fields. It's just bedlam over there. And so their wheat production is going to be way below normal and average, and even below a year ago, understandably so. So they're not going to bounce back anytime soon. And it's just going to make the region less stable. It's going to make world end users less confident about supplies out of there. If they can get it, fine, but they're going to have to figure on, you know, sporadic at best supply lines out of the Black Sea, and you know, have a serious plan B on where they're going to get, you know, some regular supplies. So it's just that constant battle of supply and demand, and doesn't make it any easier. But you know, I think the take home is, to me, this is something that's not going to go away.
Right.
Likely anytime soon for years and years. They'll be fighting through that area. You know, this nuclear plant that they've been battling around. I Googled Google Earth where that was, the city that's in. It's basically right in the middle of some major agricultural areas. Let's hope nothing happens with that. The market's been a little bit nervous about that. I would think both sides realize they don't. That is a worst case scenario if something were to happen and release radiation in that area.
Right.
So it's just it's a mess. It's going to continue to be a mess, and you know, it's just the world we live in. Unfortunately, there's a lot of instability, a lot of gray area, and that doesn't make it easy on the markets to kind of figure out what direction to go in.
Right. Okay. All right. Let's talk about protein markets here, and we'll wrap it up. So if you're looking at what's going on there, the unofficial, official, I guess it's the official, but unofficially, it's the Labor Day weekend's the the unofficial official end of summer, right?
Yeah.
So now you start looking at what's going on there. You've got some choice beef cutouts that they kind of fell. They've been falling over, and you would expect that, right? Going into September is a pretty normal time to see that kind of stuff happen. Same with hog prices and stuff, but you see across the price there. So I guess looking at those two segments, Chip, going into winter especially with herd liquidation, the way we've seen it in the number of what the actual herd looks like. What are your thoughts between, obviously we'll see the September correction that happens every year, but moving past that into through the winter, do you see a chance to see some rebound price in cattle?
Well, first and foremost, as I look here, you got deferred cattle, like February live cattle right now are north of 153. So we got a pretty stout, number out there.
Right.
All that being said, yes, I mean, we just continue to see we're now well into 2+ years of drought-led liquidation of the breeding stock. Started, west and north in the plains, and they've kind of had their struggles for 18 months or 2 years. But now it's shifted, obviously, to the southern plains and the massive drought they had. Continue to see, liquidation. I think longer term that just becomes wildly friendly. It's going to shrink the herd as if we can kind of get some better rains in these areas and get pastures healed up over time. It's going to take a long time to do that.
Right.
You get ranchers, back in the mode of, okay, now we can put cattle back out on pasture. Let's buy some breeding stock back and put them back out on grass and rebuild that. That tightens the, available supply, of animals up. So that cycle is yet to come. And when that happens, it's going to be very friendly. The deferred feeder and fat cattle markets, I think to a certain extent are pricing some of that in, and that expectation. The economy and the strength of the world economy, and more importantly, the domestic consumer here is going to be important with this. We joked around earlier. Are we in a recession? We're not. We're in a recession. It's probably going to get deeper and worse before it gets better. That's going to go into this as well. So I think what that means is, just like the grain markets, we're going to have big, wide, volatile swings. I think that when the market does sell off $8-10, it gets met with good buying and kind of regenerates consumer demand with cheaper prices. And I think we're just in this cycle of pretty wide-ranging markets. But I think over the next 12 to 18 months, especially if you'd get down the road here and stabilize the economy, and maybe the election gets people in a better mind that we're going to get out of this ignorance that we're in, and get some better confidence out in the future, and things get really friendly out there in cattle. I've also noticed here recently that the feeder cattle market is back to what I call normal, where it's almost a direct inverse to corn. It used to be like that forever. I mean, to the tick. Corn's down 10, feeders are going to be up a couple bucks. It broke that for a while. It got volatile. Some days you'd see corn up and feeders up. We're back to where it's kind of the old fashioned times. And so my point with that is corn is going to be part of this equation as well. It always has been, but it's going to be a more direct correlation now to feeders. So I think we're kind of back to normal. Supplies are tightening. The problem ahead is going to be the world and domestic economy. I think that, breaks will be bought as you get out into late winter and the first quarter of 23. Things could get really good, but we might be a year out from some like really bullish things because of the liquidation. Hog side is similar, man. We just have not, with high prices, done the expansion on the hog side that you would have expected because of COVID, because of construction costs and inflation. We just have not responded to high prices with increasing demand as you normally would think. Inflation's kind of thrown a little bit of a monkey wrench in this whole supply demand equation that normally works. And so I cautiously friendly to hogs longer term too, although I think we'll be quicker to expand out there. Again, you're looking out here, December, December hogs have been $90 not that long ago. They're still $83, $84. Historically, pretty stout level out there. But with high corn prices, high meal prices, there's not as much margin. So,
yep.
I think big picture, just to ramble on here, Casey, I know we got to wrap up, but I think the livestock, the protein sector, it is in a bull market, but it's not going to be straight up. I think we've got, a year left ish on really strong hog prices. We probably have 18 to 36 months of good things in the cattle market because of all the liquidation that we've seen. There's no way you can get around that and not have, some tightening supplies and some friendly price reactions eventually down the road here on the cattle side.
Right on. Okay. Good stuff as usual, Chip. Folks want to reach out to you and get more information about what you're doing at Blue Reef Agri Marketing. What's the best way to do that?
Yeah, best way is just call our office, 309-550-7213. Would love to chat with you. We're low pressure, low stress. If you want a second set of eyes and ears on what your current plan is and some advice on maybe how to improve it, we'd love to chat with you.
Right on. Well, I appreciate you being on the podcast, Chip.
Yeah, thanks, Casey. Have a great Labor Day. Get some R&R and get ready to turn the calendar into fall now, I guess. Summer's over.
I'm excited. All right. I am Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast and check out the video version of this over on YouTube at the Moving Iron Podcast YouTube channel. Anything Moving Iron related, go to movingironllc.com. You see the latest blog posts as well as all the entire catalog of the Moving Iron Podcast there as well. Moving Iron Summit's coming up here in Nashville, Tennessee on Tuesday, September 6th. If you're interested in coming to that, we're sold out, sorry, but you can be ready for next year. So interested, you see some more information start trickling out about that for next year. So if you're interested in doing that, hit me up and we'll do it again next year. So with that, I'm Casey Seymour with Chip Nellinger. Let's move some iron, folks. Out.
Moving iron in the 21st century. Hardwood